All right, in this video, we're going to go over support and resistance. And I'm going to say in the beginning of the video, this is a video you're probably going to want to watch a few times over to really understand this, because this video will be filled with information that you're going to refer to through your entire time of trading. So support and resistance are basically psychological levels where large amounts of market participants conduct transactions. Because if a large amount of market participants are buying and selling in a certain area, that's going to move price, thus creating these points to where you can use as references to look for evidence of support taking a trade in that area. There's going to be three types of support and resistance. Support is going to be like your floors. So horizontal support and resistance. So your floors are support because you're going to be standing on it. If you fall down from one level of a building and go into the next level, you're going to fall down on the floor. Ceilings, there's going to be resistance is going to be like ceilings. So if you're jumping and you're in a small room, and say you have a great vertical and you can jump, a few feet in the air, and there's a low ceiling, you're going to hit your head on the ceiling and go back down. There's going to be a point to where it's going to stop your momentum and come back down. That's resistance. So the third type of horizontal resistance is going to be Fibonacci. Fibonacci is a measurement tool of certain ratios that the markets like to respect in the market. So let's go over them real quick. So we're going to look at support. So we're going to look at the live market here. Go look at the live market. So support is where price finds foundation on. So basically, if price is coming down to an area and it stops and it can't break that area, this is going to be support, which is going to be a temporary area to where price is found with foundation, and it creates foundation. It has a support level. So this right here would be an example of that, because this is a floor. Floor equals support. Always remember that. So this is a support. A resistance is going to be a level or area to where price comes up to it and the momentum stops in that area. An example of resistance would be right here. This would be resistance because price is coming up to that area and is getting rejected off of that area. Resistance is on the top, floor is on the bottom, support is on the bottom. So this would be resistance. These are horizontal support resistance. Resistance equals ceilings. And these points in the market continue to be prevalent. Here's another support. See if I can find another resistance. Here's another resistance. So they're not always going to just stay ruling the chart. Here's a support here. But you can use these to find areas of where you would like to maybe participate in the market. And that's a resistance. So resistance, support, resistance, resistance, support, resistance. Resistance is on the top, support is on the bottom. The next type of horizontal support is Fibonacci. Fibonacci is, like I said, you really want to look into Fibonacci just off of trading, because Fibonacci is like natural numbers, like universal numbers that nature respects. And because nature respects it, we're part of nature. So we have a psychological bearing, a psychological preference for these ratios. So to get into it, this is the Fibonacci tool. The way to use Fibonacci, if you're going on a downtrend, to measure out a downtrend, you're going to use from the top, you're going to draw from the top to the bottom. Let me use the generic Fibonacci. So as you see, if you look at these lines, you see how these lines are identifying areas in the market where price is respecting the market. I'll use is probably a better example here. Price is respecting the market. And I basically picked this point out of random, but you can see what I'm talking about when in price respecting these Fibonacci points. See, I didn't even see this until after I drew it. Price keeps respecting these Fibonacci points, even down to current price where it's close to this point here. If I were to pick another example, let's use this. I think this would be another good example. Top to bottom. I like going from wick to wick, so the highest point to the lowest point of a certain move, and you see right away. You have price respecting here. You have price respecting here. Price respecting here. And it just keeps going. Price respecting here. Price there. And you see, I drew this Fibonacci a long time ago in price, and you see how it's continually respecting those areas. So all the way over here, price is respecting that area. Crazy, isn't it? But if you look at things like hurricanes, rose petals, even sound waves sometimes can respect Fibonacci. Some seeds in the ground, like their ratios, like a Fibonacci. But there'll be a whole nother lesson just on Fibonacci because I think that's really important in trading. But for this video, I just want you to see how price respects these psychological levels. So these are the horizontal price levels. You got your support, which is your floor, your resistance, which is your ceiling, and you have your Fibonacci levels. So let's delete that out. The second type of support resistance is going to be diagonal support and resistance. So the diagonal support and resistance is going to consist of trend lines, it's going to be price channels, there's going to be pitchforks. Those are going to be the main three diagonal support and resistance. So basically your uptrend is going to look like that diagonally, and your downtrend is going to look like that for trend lines. So let's look at some examples of the two. Delete these out. So right here, you have a trend line for this chart here is an upwards trend line. How you draw a trend line is that you want a trend line is basically you're connecting points in the market. It's like you're connecting dots of where the market respects and creates a move that comes off of that point. So you have a point here. And if it's an uptrend, you want to draw a trend line to find a support because you want to buy on uptrends and you want to sell on downtrends. So you're looking for support when you're doing an uptrend. So you see how this trend line is going upwards. So this is a uptrend. So to recap on how to draw it, first you look for 2 points. You don't need necessarily 3. You just need 2 swing points in the market. 2 swing lows for an uptrend is 2 swing highs for a downtrend. So we're going to look at this uptrend. Here's a swing low. That's the second swing low. I would connect the trend line here. I usually like to go from wick to wick and extend it out as much as possible. And as you see, price respects that trend line multiple times. For a down example would be right here. I see that there's this point, and then there's this next point here, which is the next swing high. And then you would just take a trend line and connect the two. So that's how that would work out. The next type of trend line is price channels. So price channels are going to be basically it's a channel like a tunnel, and price is traveling through that tunnel. So with that price, just like if you're driving in a tunnel, if you go too far to the left, you're going to hit a wall. If you go too far to the right, you're going to hit a wall. You're not going to be able to drive through it because there's a form of barrier at that area of the tunnel. So for a price channel, you're thinking of it psychologically the same way. So let's see if I can use this same trend line as a channel. May or may not work, but let's check it out. So you want to do exactly like you're doing a trend line. You're finding a few points in the market, and then you're going to draw it out like this. So that actually works out pretty perfectly. So this is your price channel. You see how price respects that channel multiple times. So a lot of people, when they're trading, they'll use price channels to determine their points and where they buy and enter. Now, there's different trading styles, but there's people that are really good at trading channels. So that's one way of trading of a diagonal support and resistance. The next one is pitchforks. Pitchforks is a little bit advanced, but I want you to be aware of it. So let me find a pitchfork point in the market. To really draw a pitchfork, you have to find 2 points in the market or 3 points in the market that will line up with the rest of the market. And let's see if I can find one real quick that'll make sense. Let's actually go to a different chart. Here we go. I like these better. We'll use this. There we go. So a pitchfork is one way of using diagonal support resistance. And when you see a pitchfork, it's going to work similar to a Fibonacci. When you draw it right, price is going to really line up with that market. So you want to take a swing low for an uptrend. You want to take a swing low, line it up with a swing high, and bring the pitchfork down to the next swing low. I might have to do a bigger example so you can see it better. Here's a bigger example. 1 hour. And with pitchforks, you always want to make sure you're drawing it right. So there's a kind of a bigger margin of error when it comes to pitchforks. But if you know how to draw them, then you can really make some noise in the market. So let's just use this. Let's use this. This may be too recent, but let's use it. So you got your swing low point. Move that out the way. There we go. Your swing low to your next swing high to your next swing low. And there's multiple ways of doing pitchforks. You can do it like this, but you see how it doesn't line up. There's a second type of pitchfork as far as drawing it. It's called a modified pitchfork, where you're lining up the pitchfork to line up with price. So you want to get a lot of touches. So this is my upper pitchfork. I want to make sure that's getting good touches. I want to make sure my downward pitchfork is getting good touches. So I use modified pitchforks a lot more than I use standard pitchforks because a lot of the times it's going to give me a better indication on price. So as you can see, because I lined up my pitchfork to meet the criteria as far as like a trend line, like just like I'm drawing a trend line, but these are multiple trend lines, you'll see that price will line up with it. So if we look here, let me make it easier. Let me just use the main pitchforks, not use the midpoints. Give me 1 second. Nope. There we go. All right. So if you look here, you see that I purposely modified it to where it'll line it with the higher price on the higher pitchfork. You want to make sure you have an equal and very accurate touch, because if you do that, you'll notice that you have price respecting here, price respecting there. And I only made sure that it lined up here. And the nature of pitchforks is to be like Fibonacci and trend lines put together. See, price respected here perfectly. And a price respected here. Price respected here. And you can literally just keep going with pitchforks. There's people that only trade pitchforks and make a lot of money, because you can, if you know how to draw it correctly, it can be a very accurate tool in finding price reversal or price continuation zones. The price, it respected this little bit. It broke and it retested this point. And it just keeps going on and on. Got that. Got that. That's why pitchforks are very powerful, but there is a decent margin of error because it depends on how well you can draw them. But this is another form of diagonal support and resistance. So let's clear that out. The other one is going to be dynamic support and resistance. So dynamic support resistance are support resistance that contract and expand with the movement of price. They're not stagnant lines like horizontal and diagonal support resistance. They're moving. They're almost like living support resistance because they constantly react to how price moves. So the first type of support resistance is going to be Bollinger Bands. So what I'm going to do, I'm going to go ahead and add Bollinger Bands to the chart so you can see it. So Bollinger Bands is one example of dynamic support resistance. You see how they curve and ebb and flow with the market. That's the characteristic of a dynamic support and resistance tool. So if you look here, these same swing high points happen to be, there was a trend line. Swing points are going to measure up multiple ways. So you got the diagonal support resistance. You have horizontal support resistance. I'll use Fibonacci for this example as my horizontal support resistance. And this is kind of getting into confluence, which is basically lining up multiple things at once. So you see my horizontal support resistance lines up. You see how all three things line up with this area of price. So that would have been a good area to potentially sell at because you had confluence. But to backtrack, to go back, I just wanted to show you that so you can see the importance of the dynamic support resistance. I like using a lot of dynamic support resistance because they move. They're not based off of necessarily my drawing it, but it's based off of pure price movement, and it's measured points that are predetermined by price movement. So it's a less margin of error when it comes to drawing it. So when you're using dynamic support and resistance tools, you get to have a decent, accurate idea of where price is going to make its moves. So that's Bollinger Bands. The other one is going to be moving average. So moving averages are basically a line where it takes the average price of, let's say, I'll use 50, for example, the last 50 closing prices. And this is a 4-hour chart. So the last 54-hour closing prices. And it's going to make a point. And then the next one is going to be another point, and it's going to connect the dots. And that connecting the dots is going to create a moving average line. So let's use moving average, and let's use that 50 example. And let's put it to where you can see it. Get rid of the Bollinger Band. So moving average is going to basically ebb and flow just like any other dynamic tool, ebb and flow with the markets. But with a moving average, you'll be able to identify trend by looking at if price is going to be above the moving average or trade below the moving average. If its price is above the moving average, it's going to be in an uptrend. If price is below the moving average, it's going to be in a downtrend. So that's really simple. That's why I like dynamic support resistance, because it's just, you put it on there and you can see right away where your point and where you are in the markets as far as your trend. And then of course, if price is kind of chopping between support, the moving average is kind of chopping between the price, is going to be consolidation. The last one is going to be Ichimoku Clouds. And Ichimoku Clouds, it's a little bit more, just like Pitchforks, a little bit more of an advanced way of trading, but can provide very accurate entries. So let's go ahead and add that up real quick. Ichimoku. So with Ichimoku Clouds, see, a little bit more advanced, has more things going on, but the basics of Ichimoku Clouds is going to be that if the price, just like moving average, if the price is trading above the Ichimoku Cloud, one, the Ichimoku is going to be mostly green, but two, that's going to be in an uptrend. That's going to let you know that's in an uptrend. If price is trading below the Ichimoku Clouds, it's going to be in a downtrend. If price is trading in the middle of the Ichimoku Clouds, that's going to be an indication of consolidation. So you see how price is trading all in the middle of that. So these are your tools that you can use for support resistance, and you want to make sure that you watch this video a few times. But I know that I showed a lot of different tools to where you can trade. The most important thing is know that you don't have to trade all of these tools to have a winning trading strategy. There's some people that trade with just one of these tools. There's some people that trade with two, and some people that trade with maybe 3 or 4. But I can give you people that have done either 1, 2, 3, or 4 of these tools, and all of them have been successful. It just matters about what you can understand the clearest and what's clear to you, because clarity is the most important thing when picking a trading strategy or picking a trading method to interacting with the market. So definitely watch this video a few times, and good luck to y'all.